Hi traders, welcome to the Blueberry Markets Academy. This is the beginner series, part 2 of 3, and today we're going to be discussing the different types of analysis, charts and support or resistance. In the context of Forex markets, analysis can be generally categorized into 3 main types: technical analysis, fundamental analysis and sentimental analysis. And the most common approach is to use technical analysis, and this approach involves studying price charts and using statistical measures to predict future price movements. Now, technical analysis assumes that all information is already reflected in the price and that price movements follow certain patterns. Some of the tools or techniques that are used include chart patterns, indicators and oscillators, support and resistance, trend analysis, top-down analysis, and a non-fundamental bias. The second most popular style of trading analysis is to use fundamentals. This is about evaluating a currency's intrinsic value by analysing various economic indicators and geopolitical events. In Forex, the performance of a country's economy will influence its currency value. These can be dictated through economic indicators, geopolitical events, central bank decisions, economic reports, and just general news events. The third is sentiment analysis. And now this can be used to access the sort of mood of the market participants. And this is less popular, but can be key, especially when it comes down to using tools such as the commitment of trader reports. These reports will detail where commercials, non-commercials and non-reportables are positioned in the market. I'd emphasize that while each of these methods offer valuable insights, they are most potent when in combination. For instance, a technical setup may be more reliable if it aligns with the fundamental backdrop and is backed by prevailing market sentiment. So let's say you had gold prices that you were looking at, and gold was at a level of support, and you noticed that there was a inverse head and shoulders pattern. For instance, there was some geopolitical tensions at the time as well, which would spark the market into a bit of safe haven buying, and the commitment of traders was showing us that the buyers were buying contracts at a more aggressive rate. That then you can use that in combination to potentially be a buyer of gold. When it comes to Forex trading, visual representation of price data is crucial. There are several types of charts that traders utilize to dissect price movement and identify potential trading opportunities. The line chart is the simplest type of chart, drawn by connecting a series of single closing prices. It provides a clear visual of the currency pair's historical price movement over a given period, but doesn't provide the intricate details of price action within that period. A bar chart, or open high low close bar, represents a series of time. The main vertical line indicates the high and low, while the leftward dash marks the open and the rightward dash the close. The most common type of chart is the candlestick chart. This has originated from Japan, and this chart type is popular for Forex trading. Similar to a bar chart, it displays a open, high, low and close. The main difference is the use of a coloured body to show the difference between the open and the close. So if the close is higher than the open, that body might be coloured white or green, indicating a bullish period. If the close is lower, it might be coloured in black or red, indicating a bearish period. In our case, a bullish candle is white and a bearish candle is green. This style of chart is most popular as it's easier to spot patterns like dojis, hammers and engulfing candles, which can suggest potential trend reversals or continuations. When assessing the price movement of currency pairs in the Forex markets, 2 of the most fundamental regularly used concepts are support and resistance. These levels play a pivotal role in determining the price at which a significant number of traders may buy or sell a currency. Support is a price level at which a currency pair trends to stop falling and may even bounce back upwards. In essence, it's a perceived floor for the price. The logic behind the support is that the price of a currency drops towards a level deemed to be valuable. More traders or investments become inclined to buy, thereby creating demand and halting the downward movement. A price level which has acted as support multiple times in the past is likely to be a stronger support level. Round numbers such as 1.1000 or 1.5000 often serve as support levels because traders buy orders at these points. Conversely, resistance is a price level at which price is rising but tends to stop and reverse its direction. Think of it as a perceived ceiling for the price. As the price of the currency approaches a level where the market is deemed to be overvalued, selling interest incurs, creating supply which can halt or reverse upward price movement. Once a support level has been breached, it can become resistance level and vice versa. This happens because the price breaks through a support level. The new lower price may establish a concern that the price will continue to decrease. Conversely, when a resistance level is broken, the currency is perceived to have momentum and the resistance could turn into support. Like the example here, we can see that price found support here, but then it broke through, traded through, made a new low, and then every time it reached that level, it found resistance. Connecting the lows in an uptrend or highs in a downtrend can also provide a dynamic support and resistance level. This can be used as what we would call a trend line, and the trend line can be used for trend purposes or reversal opportunities. We can see in this example here, price makes higher highs and higher lows. Now what we're doing is connecting the two higher lows together, expanding the trend line out, and you can see we have 1, 2, 3 tests of that level as support. Conversely, you could look at it as a bearish trend line as well, and also you can look at trend lines in a way that are counter trend. One way you can do this is by basically looking at how the market reacts to certain levels. So you can see here, for instance, we could draw a trend line like this, connecting these two highs of the candlesticks. Once price trades through and closes above, it could signal that further upside is to come. To summarize, we learned about 3 different types of analysis. We talked about the technical analysis, we talked about fundamental analysis and sentiment analysis. We also covered different chart types available on MT4 and MT5, which were the line chart, the bar chart, and the candlestick chart. And we also discussed some support and resistance levels. I really hope you enjoyed this 𝖢𝖥𝖣yi Academy Beginners Part 2, and I will see you in the next one.